I'm Charlotte McLeod with investingnews.com, and here today with me is Keith Weiner, founder and CEO of Monetary Metals. Thank you so much for being here. Great to have you.
Thanks for having me, Charlotte.
Really good to be speaking with you. Probably the perfect time with so much going on in the gold market, and Monetary Metals has just released its 2025 gold outlook. So we're going to make that the focus of the conversation today. I thought to ask with just a brief question to take the temperature on the gold market. So you had told us before that we were in a buy the dips market for gold, not a sell the blips market. And with the price at or near 3,000, is that still the case for you?
Absolutely.
Okay, good to get that very short and sweet answer. So let's move over and take a look at the report. So one of the really key situations it goes over is what's going on with tariffs and this movement of gold. So that's a very complex situation, and you go through it very thoroughly. What would you want people to know about that?
At the end of the day, things are simple. And if you can't explain it simply, Richard Feynman, famous physicist, said, if you can't explain it to a smart eighth grader, you really don't understand it. And there was some kind of motion. It was when you take a tennis racket, you try to flip it in a certain way, it ends up rotating. And he couldn't explain it to an eighth grader. And he said, you know what? I guess we don't really understand this well enough yet. At the end of the day, people respond to the opportunity to make a profit. Now, retail gold buyers, profit means you buy it and it goes up big time, and then you sell it and you lock in a big capital gain. And that's one way to play the market. But the institutional players are generally acting as market makers. They're not betting on price. They are net neutral to price, but they're responding to a spread. And the classic spread, and I've been writing about this for 15 years or so, is they buy spot physical metal, and at the same time, at the same instant, they sell a futures contract, and they lock in. It's a small spread. It's not a lot of money, but they can do this with great leverage, and the cost of borrowed capital is very cheap for a big bank. They can lock in a spread that we call basis. And, for the last couple of years, since Powell started hiking interest rates, the basis has gone up quite a bit. And, you're looking in the vicinity of 4 or 5%, per annum to do this trade. And so it's an interest rate that they can play like anything else. You can borrow for less than that, and you can put on that trade to make money. Okay, fine. Very simple. That's how you understand the gold futures market. It's not a matter of futures setting the price, a spot setting the price. That's like, if I clap, which hand is making the sound? I mean, come on. There's an interaction between the two markets, and that's how the world is wired, today. Now, Trump started talking about tariffs. He's been talking about tariffs for obviously many years, but in a more serious way and a more specific way, the moment he won the election. And all of a sudden it occurred to people, there may be tariffs on imported gold and silver, which there's never been before. And, that would be a great calamity. Particularly, imagine if you put on this trade, and again, you're not making huge amounts of money. I mean, 4% per annum on, $3,000 is, what is that? 10% would be $300, $30, $120 for a year. So, $10 for a month, $20 for a 2-month trade, something like that per ounce. Not a huge amount of money. And all of a sudden, there's a possibility with 25% tariff, which would be $750 an ounce. So the mechanics of this trade, nobody really thinks about it that much. And we don't generally write about the fact that spot means London. You buy physical metal in London, and futures means New York. So you're long London, short New York. And now there might be a 25% tariff to import gold or silver to New York. Think about that for a minute. So you're in this trade for 10 or 20 bucks, and there's a possibility, however remote it might be, that you could be faced with a loss of $750. What are you going to do? So, these are not individuals. I mean, these are institutions, and institutions have risk officers. And so it's not up to the individual trader to say, wave his hand. That's not the risk you're looking for, like some Jedi mind trick. right? The risk officer says, fix this, or even tells them how to fix it. And there's a fairly simple fix. It's you bought the metal in London, take it and deliver it, physically bring it into the US and have it in a vault in New York instead of a vault in London. And if you do that, then you're inside, if the tariffs slam down, you're inside the window before it closes. So much is being said about this. I won't get into all the conspiracies that the US doesn't have the gold, and now that they're threatening to audit it, they're in a rush to bring in and repatriate all the gold that they sold decades ago or whatever. A lot of people because people think in terms of price, they don't think in terms of spread. A lot of people tie this and say, well, this is driving the price up, or this is a response to a higher price, or this is strategic. See, Trump is trying to make America strong. He's trying to bring back the gold because there's going to be a new gold standard. We need the gold back in the US or whatever. This is a response to spread and the threat of a 25% loss, which people would be carried out in body bags if they had to take a 25% loss. So they want to keep the trade on because there's money to be made. And then they just bring the metal over, which as long as there's no tariff, bringing metal over in quantity is pretty cheap. You're talking basis points of cost. So then the metal's in New York. Okay, fine. If you're a big bank, you don't necessarily care if it's in London or New York. Either way, it's in the vault of a major bank. Could be JP Morgan, could be Goldman Sachs, could be HSBC. It's in a vault, or Brinks. It could be, whatever it is. It's in a vault in New York, and now you're immune to the tariff threat because your gold is already in. So that's what it is. And we see, big inflows of gold, at least relative to, what COMEX vaults had. They say what's draining the vaults in London. No, not so much. If you look at it as a percentage of total gold in London, it's barely registering above the noise floor. There are delays. I don't know if this is still true, but as of a couple of weeks ago, delays getting your metal out because there just aren't that many employees who can bring gold in or out of a vault like that. And if everybody at the same time wants to export some of the gold, you run into a bottleneck because the labor capacity, in that vault is inelastic. You can't increase it, for short-term spike. So a little bit of disruption if you're in that end of the market. Otherwise, nothing's gone at the moment until at least if there are tariffs, then all hell's going to break loose.
Right. I think that's exactly what I was going to ask you. So does this situation persist until we get some clarity on the tariff situation?
There may be a permanently elevated level of inventory in New York because at least the kind of risks that once people discover there's a risk, it never really subsides back to zero. You always have to think about it. But yeah, once there's clarity, obviously if there is a tariff, then we'll see what the new reality is. I don't think you can run a futures market out of a country that has 25% tariffs. The US is going to become a third world country like in India or a Vietnam, where they have massive tariffs on a lot of things, particularly gold. And what happens internal to those countries is the price of gold that's available on the street can bounce back and forth between $3,000 and $3,750, depending on whether demand is big enough to have to pull gold externally or whether, there's enough domestic supply to meet domestic demand. So with that kind of volatility, hedging becomes much more expensive for dealers, which means retail people will experience much wider spreads. So today, if you want to buy a gold coin at retail, let's say you want to buy one, and you go to a coin shop on Main Street, you're paying 5% over spot, something like that. And if you sell it back, you're getting spot or maybe spot plus have a point or something. Well, in a tariff regime where it's much more costly and unpredictable to try to hedge the risk for the dealer, it might be that you pay spot plus 15% or spot plus 20. And when you sell it back, they'll give you spot minus 5. So you just make much wider spreads, much bigger losses to anybody who trades in and out. Ultimately, I think it'll force the futures market to go offshore. I think places like Dubai are probably waiting for something like that to happen because you'll give them the market on a silver platter. And it'll make gold a bit less attractive, certainly to US based people. Or they'll have to own it offshore somehow. Having it inside the country will become impractical.
Okay, so I think that gives us a pretty good idea of the impact we're seeing in terms of tariffs on the gold market. Are we seeing similar activity play out in silver?
Yeah, same thing and the same possible threat. And, I don't think that it's always hard to make political predictions. I could end up being very wrong on this. I don't think they're going to tariff gold and silver. I mean, I don't really agree with the stated opposition to tariffs at all. But if you're going to tariff things like consumer goods because you're trying to protect domestic manufacturers, all the logic doesn't really apply to gold or silver. But it definitely doesn't apply. It more strongly doesn't apply to gold, and it less strongly doesn't apply to silver. So if you ended up with tariffs on one of the two, it would be silver, or gold. But the same anyway, right now it's the same dynamic, the same fear, same imports, the same, same everything. Again, if that happens, chaos that could destroy the US based refiners. Who's going to want to try to import the doorway into the US? At 25% tariff, it becomes completely uneconomical to do so. It's just a mess.
Yeah, it does sound like a mess when you lay it out in that way. So, anything further you would add on tariffs? I know there's a lot of turmoil and a lot of uncertainty in terms of the tariff situation. We hear that they're inflationary as the US is trying to tame inflation. Any other thoughts?
Yeah, I mean, I don't define inflation as an increase in consumer prices, but if that's the standard definition that most people have, and even Milton Friedman, who would have been the first to take the pedantic position, no, inflation is the increase in the quantity of money, but rising consumer prices is the inevitable and proportional consequence to that. But if you just run with that for a minute, there's now tariffs on imported Canadian lumber and aluminum and steel. That obviously means that the prices of those commodities goes up in the United States, and the prices of anything made with those things has to go up. And, I don't know how many goods are currently subject to tariff, but, if there's a comprehensive thing that just tariffs everything, then the price of consumer goods is going to go up a lot. The stated purpose is to force production to stop being done offshore and then to be, for companies to open factories and whatever, within the US. Now, if that's the case, then the reason why they're not already manufacturing in the United States is because it was more expensive to do so here. First choice was China. So if you make it, illegal or at least impractical or uneconomic manufacture in China and you get it to come to the United States, you can declare victory, but it was only because you were successful in forcing companies to do their second choice or third choice. Okay, so all this stuff is going to be more expensive if you're forced to make it in the United States. At the same time, so that's, punch number one is let's force the cost of everything to go up. Number two is let's deport. They've said tens of millions of people. I don't know if that's really realistic or not. There's obviously constitutional challenges, court challenges. That's a mess as well. But imagine you deported tens of millions of people. Yeah, sure, you're going to get some criminals and some, what is that gang? MS-13 or MI, what's the, I forget the name of the Colombian gang. No, El Salvadoran gang. Anyway, you're going to get some of those people. You're also going to get some people on welfare. You're going to get plenty of people who work. Now, so you're deporting a great deal of the workforce, while at the same time you're forcing companies to increase their demand for labor, which means the cost of labor is going to go up. They say, okay, great, that's what we want to do. We want to get Americans paid more, but we're producing less stuff at higher cost. Somebody's standard of living is going to go down pretty dramatically. But more importantly, to the inflation picture, if inflation is defined as an increase in consumer prices, and you've forced them to manufacture in a high-cost jurisdiction with much higher regulatory costs, and then deported a lot of labor to drive up the price of labor even more, then you're going to find consumer prices have a 1-2 punch. The third punch is what is everybody's solution from a monetary policy perspective to inflation, so-called, hike the interest rate, which means hike the cost of financing new factories and hike the cost of putting automation. And every factory is in a given place in time in terms of how much automation they have. And very few factories are 100% automated. The idea of a lights off factory where it's 100% automated is a holy grail that I don't think really exists yet. And every company, when faced with massively increased demand for labor and massively higher labor, is going to want to automate more. Well, the cost of financing the automation is going to be hiked. So what we're going to see is just 1, 2, 3 punch for forces pushing up consumer prices, and 2 of them aren't monetary. The third one, arguably or ironically, the monetary one is intended to take pressure off of inflation, is actually further accentuating it. And so hopefully that doesn't happen. Hopefully, tariffs bog down politically. There's blowback. People start to say, wait a minute, we're pissing off our friends like Canada. And, let's not do that. If this is all about China, fine, tariff China, but Canada, seriously? French wine, Scotch whiskeys? I mean, what are we doing here? Hopefully this bogs down, not to get political, but, and certainly I have to say, I hope it doesn't affect, gold and silver, the monetary metals.
Yeah, I think you can really start to see what a complex web of factors there are there. And I think this is a good path into talking about the Fed, which is another topic in the monetary metals gold outlook. So the report talks about how the Fed is pretty keen to keep rates higher and not go down too quickly, which may not end up being possible. So what do you see as the Fed's path forward?
I think the Fed has wanted to keep rates higher. And I think their back is up. I mean, to think that policy is set by things like personal egos is a pretty strong argument that we shouldn't have central planners, because in anybody's book as to why central planning is good, they never really address how much of it is driven by the egos of the central planners. But Trump has made it clear he wants to force the Fed to force interest rates down, taking command of the Fed if necessary. I think he's got their backup. So even if they were somewhat inclined to somewhat relent, I think now, just to justify Trump, they'd be inclined to, keep rates higher for longer. But I like to point to things that I just, actually Twitter I haven't been able to get, picture uploads to work on Twitter the last few days. So I posted it to Facebook, but I didn't post to Twitter. And it was a picture of an ad for the Mitsubishi Outlander, I think it was. And they're offering 0% interest for 60 months, 5 years. And, that even when interest rates were 0, that's obviously a subsidy by the car company to buy the car. And now with interest rates much higher than they used to be before 2022, the cost of that subsidy has gone up dramatically. Why are they doing this? Well, obviously because if they don't do it, sales are going to fall off a cliff, and that loss will be greater than the loss they're taking on the subsidized, loan. But from a monetary policy perspective, this shows that the demand for credit, at least in the vehicle market, which is business as well as personal, obviously, is very soft and non-existent except at 0 interest rates. You want to sell cars, you can't sell cars with 7% financing. Well, let alone, market would be more than 7. Market would probably be 8 or 9. You can't sell cars with 8 or 9% financing. You're lucky to sell cars with 0% financing. And I think that's true everywhere you look in the business world. There's no demand for credit, whether to open a new factory, open a new hamburger restaurant, add to your production line if you're making hamburger grilling equipment or fryer equipment, and you need to borrow money to do that. There's no demand for credit except on a downtick in the interest rate. And so is the Fed going to be able to continue to sustain this high interest rate against all of those other forces, which I'll call them recessionary? I don't know if, I can't tell you the exact timing of when this all collapses. But like I said, the forces are all pushing down on interest rates, not higher.
Right. And speaking about recession, I believe for you, the likelihood of a US recession has increased compared to where it stood last year. So is there anything you can say on that, maybe looking at the length and potential severity of a recession?
I mean, if you just do cursory look at history, this incredible boom that we've had, which is really the same boom since 2009. So it's been Obama for 8 years, Trump for 4 years, Biden for 4 years, and now, getting into Trump's second term or first first of his second administration. I don't know how you count it. It's just a very stale, old boom that's gotten very long in the tooth. And normally the thing that breaks these things, they hike the interest rate. That causes, debtors to default somewhere at the margin. Certainly we've seen commercial real estate, given the, COVID got everybody out of the habit of going to the office. And then, some companies are trying to force people to go back to the office. I don't know if that trend is going to be particularly successful. Now, of course, monetary metals, we've always been a remote company anyway. So we're somewhat amused by the whole thing. But I think the amount of commercial office space that has been built is a lot higher than the amount of commercial office space that's needed in this new environment. I don't think the office is going away, but I think a lot of workers are going to come in a couple of days a week, but not 5, which means hoteling and hot desks and all that kind of stuff. And so, commercial landlords are, in the world of hurt. It's all finance. It's all on credit. People who buy houses, the saying, even when I was buying my first house in the 1990s, people don't buy a house price, they buy a payment. So at much higher interest rates, you get much higher payments. So there's a problem there. And I just think we're headed towards, first of all, dropping demand for anything that's credit sensitive, and rising risk of default. When that all hits, who knows? And now tariffs just simply going to mean if you drive up the cost of things, people can afford less of it, right? So people are going to buy less, whether it's laptops, whether it's avocados, whether it's wheat. Well, some prices may crash. So if all the other countries slap retaliatory tariffs on, the U.S. is a net exporter of things like wheat. So the wheat price would crash, at least temporarily, until you put all those farmers out of business. And by the way, they default on their loans at their banks, and their banks are going to then retrench and pull credit back and so on. And then longer term, you may end up with higher wheat prices. But anything we import, avocados being one, Canadian maple syrup, Canadian lumber, aluminum, steel, anything made with metal, basically, those prices go up. People afford less. And that means there's fewer jobs for the distributors, the truckers, the shippers, the retailers. You get a lower volume as people are poorer and, forced to discover the joys of staying home. And, you don't necessarily buy, if you're poor, maybe you can't buy toys for Christmas presents for your kids. People rediscover whittling a little whistle out of wood or something. I don't know if kids today would be satisfied with that. The way my grandparents today, they were. But you just get a reduction of volume, reduction of employment. You get that general malaise that, last existed in the 1970s.
And I think from what you're saying, we start to get a sense of what happens to the dollar in these circumstances, but anything you would add on that note?
So dollar is very interesting. The dollar has built a network effect that is, I think it can't be displaced, right? So if you're in the rest of the world, you don't like your local currency because the local currencies are worse. Just that data in the United States is much more plentiful, so we're much more apt to be talking about problems in the U.S. currency. But those problems exist in all the other currencies, number one. Number two, they're all dollar derivatives anyway. Number three, many of them have capital control, so they're completely useless outside the borders. And even currencies like the euro or the pound, there's no capital controls, but there's no demand for euros outside the borders of the Eurozone. There's no demand for sterling outside the borders of the UK. And so the world is stuck with the dollar, whether it wants it or not. Tariffs just means it's harder to get revenues by sending goods to the US, which means it's harder to service your dollar debts, which aren't going to go away anytime soon because everybody's in debt up to here. And so, ironically, you could see a stronger dollar against the euro and the pound, yuan, et cetera. Not in a good way, but just as a perverse consequence of very perverse circumstances.
I think we've taken a look at quite a number of the factors that are important for gold right now, but is there anything else that you are keeping an eye on that you feel is important?
Always look at the gold basis, which is available for free on our website. It's one of the graphs we published. which gives you a sense of how the basis is moving with the price. So if you see rising price accompanied by rising basis, which means the futures contracts are getting more expensive relative to spot, that spread is widening. That means the buying is occurring largely in the futures market. That is the pattern we saw from, after August of 2011, when the gold price had its peak the last time around, just under $2,000, through 2018. But every time the price would go up, you'd see the basis rising. And it was easy for me to make the call time and time again. I got hate mail for this, but I was right. Damn it, I was right. That this is not a durable move. This is people in the futures market front running only themselves. The price will come back down. We had articles looking at the half-life of, how long would the move take before it reversed, and so on. So if you see that, that's really bad. If you're expecting the price to go up, that's not the pattern we've been seeing, post-COVID, and certainly the last, 2024. What we're seeing is the basis, either refusing to go up stubbornly or even declining slightly as the price goes up, which means it's all been driven by buying in metal versus buying futures, which is a very important distinction. People who buy metal are much more likely to be holding that for years or decades. People who buy futures generally do so on very great leverage. You can do that on 20-to-1 leverage. And if you're buying something even on 10-to-1 leverage, you have to sell it fairly quickly. That leverage has a cost. Number one, you're not going to hold that position for too long. Number two, if the price goes up, you take profits. That was the whole point. If the price goes down, you have to cut losses. You have to stop. So either way, people jump into the futures market to speculate, jump out fairly quickly. People who buy coins, take them home and stick them wherever, in a safe, under the floorboards, whatever. And generally, those aren't coming back to market for a long time. So that is a durable, bit of demand. And the demand that we've seen has been of that sort, where you see the basis stubbornly refusing to rise with a rising price, or even falling a bit. Nothing dramatic. I don't see permanent gold backwardation or any of those scenarios happening yet. But there's a reason why everybody's buying gold. And it's not because they're betting on its price, not yet. When that happens, you'll see the gold basis rising. It's because people are concerned about credit risk. And sure, the dollar may go up relative to the other currencies because everybody's defaulting. But do you really want to be a creditor in a world where everybody's defaulting? Sure, the surviving credits go up in value, but there's a risk that maybe your credit isn't one of the ones that makes it. And so, there's a monetary madness going on. Everyone expects that's going to get worse, right? So look at COVID. Enormously destructive economic policies. We locked down the whole economy. And we said, okay, only certain industries are deemed to be vital. They're allowed to be unlocked. And that was, you started to see the stock market collapse. But then how did they fix it? Massive stimulatory, both monetary policy and fiscal policy. It was like Oprah Winfrey, and you get a free $10,000 check, and you get $10,000. You get, everybody getting free monies all over the place. That's how we made the stock market go up and continue the boom. Well, I think with good reason, people are expecting that to compensate for tariffs and other destructive policies, that, there will be another fiscal stimulatory effort, as well as getting back to the Fed, a monetary stimulative effect. Well, it's a good thing to be owning gold when they're going mad like that. Gold is the thing you want to own, not necessarily stocks where, okay, they're stimulating, but, sales volumes are falling, revenues are harder and harder to get, margins are getting crushed. Gold is the thing to own. And so I think that's obvious globally. Everyone's buying gold for this. And this time I'd say for better reasons. In 2009 to 2011, everybody bought gold after fear consumer prices were going to rise as a consequence of QE. And consumer prices didn't really rise as a consequence. Commodity prices rose in a speculative wave and then fell. Today, look at everybody talks about inflation. I bet you have a lot of guests on your show that talk about inflation and money printing. Do they admit that the price of oil today is well under half of what it was in 2008? The last time I haven't looked at oil today, but last week it was like $66 a barrel and $145 a barrel in spring of 2008. So with all this inflation, why is oil cheaper than ever? It's a very funny thing. And so anyway, people were buying gold as a hedge against this. And when it didn't happen, they all sold their gold. And the price of gold came right back down to the floor that had been, the ceiling up to 2008 was $1,000. Right after everything fell apart, eventually gold made a low in 2016 or 2017, I think 1,040. It was right back to that as a floor. It's been up since then. But I think people today are buying gold for a fundamentally right reason, which is credit fear, rather than a fundamentally wrong reason, which is that monetary policy is going to create higher prices, which was not true then.
Very, very interesting to see that shift. And, from the way that you're looking at gold, does that allow you to put a price range for the metal this year, or is it more that we're looking at upward movement?
I don't want to give away what we said in the report, because we do make some price targets, but I think substantially higher prices, coming ahead. All the fundamental drivers are in place for it. And as more people discover it, more people get on board, it becomes a reinforcing feedback loop at some point. And that's when you'll see the seeds of potentially correction. The more people that are buying simply because they saw the price chart, rather than buying because, they're thinking about getting out of so much credit exposure, then that'll drive the price to that parabolic top. And then after that, a predictable correction. But, corrections are not. And, I think in the report I said, I do expect a correction at some point. At the moment that I had to submit the piece that I wrote, I said we might be in the middle of that correction. Obviously, that proved to be only very short-lived, 2 or 3 days. And right after that, on Friday, we made over $3,000 in the morning. I haven't looked at the price today, but I think it's right just about there. It wouldn't surprise me if we decisively break through 3,000 this week. Wouldn't surprise me if we had a correction. People love psychological lines in the sand. 3,000 is an even number. I mean, it doesn't mean anything to the gold market, but it's a psychologically even number. Could there be a correction now? Could it be next month? Yes. But longer term, the trend is up.
Okay, I think that's good to go over. And I have to throw in a question about silver as well in terms of where it's going, because I think people are very familiar with the idea that silver follows gold, and they're really waiting right now for silver to start following a little bit more. So thoughts on this silver price moving forward?
So here's where we get a bit of a divergence. And, divergence both silver relative to gold and silver relative to past bull markets. Obviously, in the run up to 2011, silver massively outperformed gold. And we ended up with a gold silver ratio of 30 versus, 90 or whatever it is right now. At this moment in time, again, looking at the basis, but also just kind of looking at the macro, the drivers for silver just aren't as strong. The fundamental demand for silver isn't as strong. And I think the reason is silver, partly there's the industrial uses of it. And I think industrial use in a tariff environment, even if silver isn't tariffed, the goods that silver goes into, the rest of the metals and the other things in there and the goods themselves will, be tariffed. But silver, to the extent that there's a monetary component to it, silver is the money of the wage earner. And I think the wage earners are under stress and have been for a long time. And so you're just not seeing the wage earner, the stacker, being able to stack silver the way they would if the jobs market were better. Gold is much more the asset for the capital owning class. People aren't buying gold out of their weekly wages. Very few people make such weekly wages to buy 1 ounce. If you're putting aside 10% of your weekly wage, who makes $30,000 a month? Not very many people. Who makes a week? Excuse me, per week. To buy an ounce of gold in it for a weekly wage. But for silver, a lot of people make, well over $330 a week. So they can buy a couple ounces of silver out of the weekly wages. And so it's always been that way. Silver has always been that way for working people. Gold is trading against other capital assets. So as long as people have fears about stocks, real estate, bonds, I just read a thing about the classic car business. And now that baby boomers have reached the point where they've stopped acquiring more 1971 Chevelles and 1968 Mustangs, and some of them are forced to sell, ill health, obviously death, whatever. Younger generations, my generation is Gen X. We never, we didn't grow up with those cars. By the time I was in high school, those cars were already old clunkers. And there's some kids who had them, but they were junky, they were clunky, they were rusted, they were unreliable, they're always being repaired. We didn't have the same fond memories of those things. And obviously the millennials, very little experience with those cars. I don't think the demand is there. So people that are selling assets, and some of those old, cars, the ones that have really been restored to factory condition, are kind of assets. If they perceive that to be a dead asset class, they're selling that to buy another asset. It's not to go binge on consumer goods. It's something that's going to preserve their wealth or their purchasing power. What are they, if they're selling classic cars because of that concern, what are they buying? Well, gold is one of those things. So all roads come back to gold right now. And for people who know me long enough, I've definitely not been a perma bull through the whole long dark years. I got hate mail for they called me a perma bear. Now I feel like I'm a perma bull, saying everything leads to a higher gold price, but I call it like I see it.
Yeah. Interesting to see that shift there. So I think we've taken a pretty good look at gold, a little bit at silver. I'll let you go, but before I do, any final thoughts you would share with investors? I know there's a lot of noise and confusion out there right now.
Be very, very careful in taking on debt. The asset that you finance with that debt could go down dramatically in value. Interest rates could be a wild ride. The ability to generate the revenue to service the debt could be tough. The bank could be pulling back the credit, especially if you're borrowing short to finance a long asset. Be very, very careful. We're in potentially uncharted territory, or maybe, do I say, smooth Holly, territory where, there could be several major shocks to the economy coming. So now is the time to deleverage, own something, safe and secure, spend less, and be careful.
Okay, well, I think that's a good point to end with. So thank you very much for coming on today to go over the report. I think it was really helpful.
Thanks for having me.
Of course. And once again, I'm Charlotte McLeod with investingnews.com. And this is Keith Weiner with Monetary Metals.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.